Imagine you're sitting across from a financial advisor. You ask, what's the smartest way to invest for the long term? Without missing a beat, they say, just buy index funds. Low fees, instant diversification, and you'll beat most Wall Street pros. It sounds like a magic formula, so simple, so safe, so foolproof. But what if I told you there's a side to index funds that almost nobody talks about? Today, we're pulling back the curtain on the hidden truths, overlooked risks, and uncomfortable realities behind the world's most popular investment. Because while index funds have changed the game for millions of investors, there are crucial details and silent dangers that rarely make it into the sales pitch. If you think you know everything about index funds, think again, because the real story is far more complex, and understanding it could make the difference between quietly building wealth and walking straight into a financial trap. Let's start with why index funds are so beloved. They track the market, not individual stocks. That means you don't have to guess which company will win or lose, you just ride the wave of the entire economy. The fees are rock bottom, and history shows that most active managers can't beat the index over time. For decades, legends like Warren Buffett have praised index funds as the best choice for everyday investors. It's no wonder trillions of dollars have poured into these funds, making them the backbone of retirement accounts and portfolios worldwide. Index funds promise simplicity and peace of mind. You don't need to be a stock-picking genius or spend hours researching companies. Just set it, forget it, and let the market do the heavy lifting. For many, it feels like the closest thing to a cheat code in investing, a way to capture the growth of the entire economy without the stress or complexity of active trading. This reputation has made index funds the go-to answer for anyone looking to build wealth steadily and safely over the long term. But here's what most people miss. Index funds aren't magic boxes. They're built on rules about which companies get included, how much weight each stock gets, and when changes happen. For example, the S&P 500 isn't just 500 companies with equal influence. The biggest companies, think Apple, Microsoft, Amazon, carry far more weight than the smaller ones. When you buy an S&P 500 index fund, a huge chunk of your money is actually going into just a handful of tech giants. That's not as diversified as it sounds. In fact, the top 5 or 10 companies can make up a surprisingly large percentage of the entire fund, meaning your investment is quietly concentrated in a few names. Even though you think you're spreading your risk across hundreds, the index fund feels like a broad net, but in reality, it's more like a spotlight shining brightest on the biggest players and leaving the rest in the shadows. This hidden structure is one of the most overlooked truths about index investing, and it's a detail that can have a huge impact on your returns and your risk when the market shifts. This leads to a hidden risk concentration. Over the past decade, the top 5 companies in the S&P 500 have made up more than 20% of the entire index. If those companies stumble, the whole index takes a hit. In 2022, when tech stocks crashed, millions of index fund investors felt the pain even though they thought they were diversified. The truth is, index funds can quietly become top-heavy, exposing you to risks you never signed up for. What looks like a broad basket of hundreds of companies is, in reality, heavily tilted toward a handful of giants. If just 1 or 2 of those leaders falter, your entire portfolio can suffer, regardless of how many other stocks are in the mix. It's a silent vulnerability that most investors never notice until the market reminds them the hard way. So while index funds promise safety in numbers, the real story is that sometimes those numbers are all pointing in the same direction. There's another problem. Almost nobody talks about the feedback loop. As more money flows into index funds, those funds have to buy more of the biggest stocks, simply because they're the biggest. This pushes prices even higher, attracting more investors, and the cycle repeats. It's like a popularity contest where the winners keep winning until they don't. The more popular a stock becomes, the more index funds are forced to buy it, regardless of whether the company's fundamentals actually justify the price. This self-reinforcing cycle can inflate bubbles in the largest stocks, making the entire market more fragile. If the tide ever turns, if those top companies stumble or investors start to panic, The sell-off could be brutal because everyone owns the same names and everyone tries to run for the exit at once. What looked like a safe, diversified bet can quickly become a crowded trade, amplifying both the rise and the fall. This hidden feedback loop is a risk that rarely gets mentioned in the sales pitch, but it's one every index fund investor should understand. Index funds are often sold as safe investments, but that's only true in the long run if you can stomach the ride. When markets crash, index funds crash too. In 2008, the S&P 500 lost more than 50% of its value. In 2020, it dropped over 30% in a matter of weeks. If you needed your money during those times, you were out of luck. Index funds don't protect you from market risk, inflation, or panic selling. The reality is, when the entire market takes a hit, so does your index fund. There's a secret shield that keeps your portfolio untouched. And if you're forced to sell during a downturn, those paper losses become real. Even worse, index funds can lull investors into a false sense of security, making it easy to underestimate just how volatile the ride can be. The truth is, while index funds are powerful tools for building wealth over decades, they're not immune to the storms that hit every investor sooner or later. You've probably heard that index funds are perfect for set it and forget it investing. But here's the catch. Markets change, your life changes, and the index itself changes. Companies get added and dropped, sectors rise and fall, and your own goals might shift. If you never rebalance or review your portfolio, you could end up with way more risk or way less growth than you planned for. Over time, certain sectors can quietly take over your index fund, or your asset allocation can drift far from your original plan. Maybe you started with a balanced mix, but after a few years of tech stocks surging, you're suddenly much more exposed to a single industry than you realize. Or perhaps your personal situation changes, you need more cash, or your time horizon shortens, but your investments don't reflect that. The truth is, even with index funds, a hands-off approach can lead to surprises. Smart investors check in regularly, rebalance when needed, and make sure their portfolio still matches their real-life needs and risk tolerance. Set it and forget it sounds easy, but true financial security comes from staying engaged even if it's just once or twice a year. Let's be clear. Index funds are not a shield against all dangers. They can't save you from inflation eating away at your returns, from currency swings if you invest internationally, or from systemic shocks like financial crises. If the whole market tanks, so does your index fund. And if you're only invested in one country or sector, you're still exposed to big risks. Even the broadest index can't protect you from events that hit the entire economy like recessions, wars, or sudden policy changes. And while diversification within an index helps reduce the impact of a single company's failure, it doesn't eliminate the risk of a market-wide downturn. If you're relying solely on index funds, you're still riding the same roller coaster as everyone else. The key is to recognize what index funds can and can't do, and to build a strategy that accounts for the risks they leave uncovered. There are times when index funds aren't the best answer. If you need your money in the short term, can't handle big swings, or have specific goals, like income or ethical investing, you might need a different approach. Sometimes a mix of active management, bonds, or alternative assets makes more sense. For example, if you're saving for a house you want to buy in 2 years, the ups and downs of the stock market could put your plans at risk. Or if you want investments that align with your personal values, a generic index fund might include companies you'd rather avoid. And for those who need steady income, dividend-focused funds or bonds might be a better fit. The one-size-fits-all advice doesn't always fit. Smart investing means matching your strategy to your unique timeline, risk tolerance, and goals, not just following the crowd. So, what's the real truth? Index funds are powerful tools, but only if you use them wisely. Don't just buy one fund and forget it. Diversify across different indexes, including U.S., international, bonds, and even real estate to spread your risk and capture growth from multiple markets. Watch out for hidden fees, especially in smart beta or specialty index funds that promise to beat the market, but often come with higher costs that quietly eat into your returns. Make it a habit to rebalance your portfolio at least once a year. This keeps your risk in check and ensures you're not accidentally overexposed to a single sector or asset class. When markets drop, don't panic. Remember, the long-term trend is your friend, and history shows that patient investors are usually rewarded. And above all, always make sure your investments match your personal goals and timeline. Index funds aren't a magic solution, but with a thoughtful approach, they can be a powerful foundation for building real, lasting wealth. Index funds are one of the greatest financial inventions of our time, but they're not perfect and they're not foolproof. The truth nobody talks about is that every investment has risks and no strategy works in every situation. If you want to build real wealth, don't just follow the crowd. Take the time to understand what you own, why you own it, and how it fits your unique journey and goals. The smartest investors aren't the ones who know the most, they're the ones who keep asking the right questions. Stay curious and adapt as life and markets change. So, share your thoughts and experiences in the comments below, and subscribe for more myth-busting, practical financial analysis. Because in the end, real financial security comes not from blindly trusting anyone's strategy, but from staying informed, thinking critically, and making choices that truly work for you.